The most undersold mortgage product in the industry, a joint borrower sole proprietor mortgage allows multiple people on a mortgage while only one applicant owns the property and is named on the title deeds. This is usually aimed towards helping family members get a foot on the property ladder or to move home. You can maximise your mortgage borrowing by combining incomes but keeping sole ownership of your property. This scheme can be used in a number of ways, such as helping first-time buyers with a lower income to get onto the ladder, helping someone who is separating from their partner looking to buy them out, or a newly self-employed person with less than 2 years worth of accounts. Essentially, the higher the income, the higher the mortgage loan available. An example of this would be someone buying on their own with a 10% deposit of £30,000. Let's say they want to buy a home at £300,000, which would mean they would need a mortgage of £270,000. Many lenders are going to cap the borrowing at 4.5 times the borrower's income. If this applicant had an annual salary of £40,000, that equates to a maximum mortgage allowable of £180,000. There are a select few lenders that may offer up to 5 times income, but even then the maximum loan would be £200,000 and they couldn't afford to borrow the £270,000 required to buy this property. However, if they were to add a second borrower to the application who earned £30,000 per annum, it would give a combined total income of £70,000 per year. This means that if we times that by 4.5 times the income multiplier that the lenders use, the lenders could consider lending up to £315,000, and so they'd be able to buy this property on a joint borrower sole proprietor basis. I often get asked, will extra stamp duty be payable if the person going on the mortgage already owns a property? The short answer is no, as the person is only going on the mortgage for affordability purposes. They are not named on the title deeds, so essentially do not own the property and therefore will not pay stamp duty tax. One of the most crucial things to consider is whether you can afford to pay a joint borrower sole proprietor mortgage on your own. If you are adding someone to the mortgage but intend to finance the monthly payments yourself, please keep in mind that the other person will be obliged to pay the mortgage if you don't. And that needs to give some serious consideration to all of the other financial implications involved. It could be useful to sit down and calculate your income and expenditure and what your future outgoings will be. So surely there must be a downside to the joint borrower sole proprietor product. Well, the only con is that the term often has to finish before all applicants retire. So if the second applicant is, say, aged 55, the maximum term would be 15 years if they plan to retire at age 70, or 25 years if they plan to retire at age 80. So that's the end of the video. If you want to find out anything more about the joint borrower sole proprietor mortgage, feel free to get in touch. I hope you found it useful. I'll see you on the next one.